with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for the Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, and thank you very much for tuning in to the show. Each and every week we come to you to try to help you with solutions to both buying and selling homes, obviously, as well as refinance, although refinance has really been priced out for many, many people. If you have a 3% mortgage, there's no way you're going to want to reprice that to a 5.5%, 6.5%, 7% mortgage, right? Although, if you do need money, what are some of the options that you can take your advantage of? And we're going to get into that with some of the guests that come on the show today. A couple bank reps, certainly some of the people that work for Malibu Funding, the company that sponsors this show. NMLS number is, 6920. And so I've been thinking not only about the show, but about the mortgage industry, real estate industry, what's happening locally here in Southern California, what's happening in the KCAA market, and to the people around San Bernardino and Riverside counties. Yeah, it's a very challenging time because a lot of people would remember back to 2008, and we always go back to that. Why? Because that was a very, very tenuous time in real estate where we saw probably 2/3 of the homes that were purchased during the previous 4 or 5 years be underwater. And when we say underwater, what that really means is you owe more than the house is worth. And a lot of people are worried about that right now. And these people in those areas, San Bernardino, Riverside especially, remember going up to 15, out to 10. They all remember those days when properties either they owned or properties that their neighbors or friends or family owned were in that exact position. Are we going to get there? What's going to happen? So I listened to an interview recently with a guy named Bob Brokersmith, and he's the president of the Mortgage Bankers Association. And I'm just going to go down a list of a few things that he said about the mortgage market. Now, as we all know, the mortgage industry is a business, and people in that business look for opportunities to make money. So a lot of this is skewed through that eye, through that lens, but it does give you an understanding from a professional standpoint, somebody who's a big mucky-muck up in the mortgage business, and what they think about what's happening in the mortgage industry. This is Bob Brokersmith. He's the president of the Mortgage Bankers Association. Now, I wrote down these notes, so don't take it as a verbatim, but they're pretty accurate in terms of the sentiment and also some of the numbers that he shouts out. Okay, recession. Is there going to be one? Shallow is what he said. I kind of agree with that. I've gone back and forth and vacillated over the last 3 months or so because it was very unclear, especially, that election funny, silly season that we just went through. And it happens every 2 years, either on a national with the presidency or on, the local area for your local Congress people, your local city council people. It just makes your whole thinking process crazy because you get bombarded with things that aren't facts, opinions, and whether it's online, mostly online, or if you watch the news or even read a newspaper, those people that still do. But my thinking right now, and I agree with Bob, shallow recession. And I say that because of some of the indicators economically that are, they will be coming out and have come out by the time this airs. The Consumer Price Index, the GDP for the year, the December reading on a number of economic fronts. We don't normally look to the stock market when we talk about the economy because the stock market, like Vegas, is really a big gamble. Now, there are a lot of people who are experts in that field and will tell you that they know, or at least they have a preponderance to know, or at least they have a strategy by which you can protect your money. But let's face it, it's a big gambling house, and if you can play in that game, good for you. The unemployment is at 5.5. No, what is that? UE. Yeah, the unemployment rate is at 3.5%. Now, 3.5% unemployment rate is outstanding. It ranks up to some of the lowest that we've had. And certainly in your area, in the area that the show covers, San Bernardino and Riverside counties, some bits of L.A., Orange County, up to Indio and out to Palm Springs, Yes, this is a low number historically. This is like never happened before. And we still have 10 million jobs unfulfilled. So in regards to the economy, in regards to jobs, in regards to employment, that looks pretty good. 25 to 30% drop in mortgage employment. Well, I'm in that business. I laid off 25% of my workforce. Now, I think in mortgages, in escrow, in title, in home inspections, in any number of other real estate agents, per se, that business is going to get hit hard. Why? Obviously, rates went up, right? Rates went up to 7%. Although we have seen the rates drop, and the rates right now are about 6.1% to 6.2%. Not outstanding, but not bad. If this was 2016, 2017, I would say, hey, that's not too bad at all. 6% mortgage interest rates mean that you probably, if you're making over 200 grand a year combined income, can afford a house in this particular market. Another thing that Mr. Brooksmith said, 40-year low delinquencies. Now, when we talk about the difference between '08 and today, and what is happening in this recession with this inflation versus those times, and the way that the mortgage market melted down because of the product, what we're saying is that the delinquencies today are at 40-year lows, meaning that everybody can pay their mortgage. They are not in the same situation that 25% of the people couldn't pay their mortgage. The reason, obviously stated, you have equity in that house. You're not going to let it go to the bank. If you owe more than it's worth, yeah, you're going to seriously think about it. Why? Because why pay on something that's going to take you 5 years to continue to make sure that you pay off and the property comes above the waterline, i.e. it's worth more than you owe? Just go bankrupt, and in 2 years you can buy another house. That was the thinking at the time in '08. Today, the thinking is, no way I'm giving up 25, 30% equity in my house that I got during COVID. By the way, during COVID, 47% increase in equity, and we're predicting in this recession the possibility of your price going down on your house, what it's worth, by 15 to 20%. Do the math. That still means you're up by 30%. That's a pretty good deal. Underwriting is strong. Yes, it is. It is not easy to get a loan. It is not simple or straightforward. The ability to repay rule that came about through Dodd-Frank was one of those items in the mortgage industry that allowed bankers and investors, i.e. Fannie Mae and Freddie Mac, to relax a little bit, knowing that there was responsibility to the loan officer, whoever it is, or that they work for a bank or a mortgage banker or a broker. They have responsibility to prove to the underwriter that that loan can be repaid. So that's pretty good. The ability to repay rule, that's good too. Remote jobs, that's also one of the things that makes this particular environment much different than it was in 2008. 2008, you got laid off and you left the office. Today you're at home. You can get lots of different jobs from home. You don't necessarily have to be working for the company that you're working for currently in order to be able to work at home. Flexibility and the ability to be able to work at home has allowed American workers to be able to be as competitive, if not more competitive. When it gets institutionalized across the board in many industries to be able to have options, productivity will go up, even though we have seen it decline over the last 18 months. End of 23, as I said, the interest rate on your mortgage, what did he say? He said 5.2%. That's pretty amazing. 5.2%? Wow, you can actually see yourself buying a home at that. Maybe even if you had a mortgage at 4.5%, you might think to take equity out of your house, even though you're going to increase your rate by a half a point, it still may be worth it. And the last, please, no national drop in home prices. This is what he says. Now, I've seen in certain markets already that there are people who owe more today than they did when they bought the house in 2022. He says this is not going to continue. This is Bob Brooksmith, the president of the Mortgage Bankers Association. It's a big national organization, and these are his thoughts on what's happening in the economy, what's happening in the mortgage and real estate world. I happen to agree with a lot of it. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Really appreciate you listening, tuning into the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Really appreciate it. Our great station out there, KCAA. Anybody who's listening, you can follow us on the KCAA website. Certainly, we're on a number of different podcasts as well as a result. We're certainly on Spreaker. We're on Apple Play. We're on Google. We're on Spotify. All the big number of them. Are we also on podclips.io still?
We certainly are.
Okay, excellent. So podclips.io, that's a great place where you can go. If you don't know what podcasting is, now, of course, most people do. Podcasting really blew up in the last couple of years, especially during the pandemic. But podclips.io is a place where you can centralize where you go to get a number of different experts in any field, whether it's finance, whether it's lifestyle, whether it's sports, whether it's cooking, whether it's health. There's all kinds of things that you can get there. Podclips.io. Again, I'm Jeff Barton, and this is The Mortgage Voice. Thanks for tuning in. With us once again, a great guest and friend of the show and works for Malibu Funding is Charles Giscon to give us a little bit of a pep talk for 2023. Charles, how are you?
I'm great, Jeff. Thanks for having me again.
Thank you very much. Okay, so I just read in an earlier segment the president of the Mortgage Bankers Association. He came out with an interview on Housing Wire, took down a bunch of notes. He had a lot of interesting, positive things to say. Now, granted, he's in the industry and wants to pump us, but where are we right now, especially for our listeners who are looking to purchase? What's the story with the marketplace today?
Interesting. Obviously, despite all the different stories and people viewing the market conditions and prices worsening and then improving and worsening, going back and forth, I still think we're in a great state to get a deal done. And the reason why I say that is, Jeff, I just recently had a person purchase a traditional loan, get a traditional loan, home loan purchase, and they still were able to get a 5.625 on a 95% LTV transaction, which is fairly decent, Jeff.
That's not bad, right.
Yeah, considering what's going on with the market. So we're able to get that house. It was a $410,000 purchase. So it's actually in the conforming limits, which, for those who don't know, conforming limits means in the limits and guidelines that don't consider it to be a jumbo for a particular area, whatever state or city that you're in. It was a conforming loan, and so it really worked itself out. I mean, the borrower was very happy and very surprised at the interest rates. So they're still available, and even with the FHA or government loans, the interest rates can be even lower than that. So there are still full doc loans that are offering low rates, and right now when we're talking about low rates, we're talking about anything below 6% is a low rate. So that's still out there. For sure.
A couple months ago, of course, it was almost to 7.5%. So we consider, anything in the low sixes, high fives is outstanding, and even historically, it's outstanding.
Absolutely, Jeff.
Let's talk a little bit about some of the choices in the non-QM space. Explain a little bit about what that is and how you might be able to help somebody who may have some challenges with their credit or business or just doesn't want to show what they make on a yearly basis. Give us some examples of programs out there that might be able to help borrowers like this.
Absolutely. What Jeff is talking about is when he says non-QM, Jeff is referring to a non-qualified mortgage. It means it's considered will abide by TRID or RESPA, but what it means is that some of the red flags and some of the overlays are taken away, which allow a borrower who may have some credit events that have occurred or just doesn't want to show what's under the hood in regards to their tax returns or how their financial structure truly is in and out, can utilize alternative options in regards to financing. What that means is you can use your bank statements, you can use a profit and loss, you can use a CPA letter that will take the place of the 2 years of tax returns and W-2s that a traditional loan may request. And when you do that, people obviously have a better opportunity to to get approved, because now if you're looking at bank statements, you're looking at the amount of deposits and you're taking the average of that, and that may allow your debt to income ratio be lower and your income to be higher on a monthly basis. These are loans that will allow individuals who may be up against it because, with their tax returns, because they write everything off or write a lot of things off. This will still allow someone to qualify. And the credit that they would need doesn't necessarily have to be A1 credit. You can still get qualified with a 620 to 640 FICO score. So there's many different things or options that you have that can get you into the market to buy your primary, your secondary, or your investment properties, and still be able to use these means or this income option in order to qualify with.
No, these are excellent programs, especially for those borrowers there are so many people out there who want to buy, and the rate is not necessarily the number one consideration. Isn't that right?
Correct. Right now, you find out who the real dogs are out in the industry when you're not selling on rate. When
Right.
you are truly selling to a client who has a need that understands that rate is not going to be their first priority, because everyone essentially has a bad rate or a rate that we haven't been used to within the last 3 to 5 years.
Right.
So now what happens is if you're looking at these programs, you're looking at the path of least resistance,
Right.
the structure that's going to allow me to get in based upon my structure, whether I'm an entrepreneur or just an individual who may want to do a stated loan and doesn't have their taxes filed yet. It's going to be based upon those different terms and different features of loans that will allow someone to get in and still give them benefits, but that not necessarily are now not based upon interest rate.
Yeah, I think the whole interest rate argument is very interesting, because quoted interest rates on websites and on the TV, they're all for A papers, 800 plus FICO score people with 20% down. This is what they're quoting. So they're not even getting the real quote when they're looking at advertisements anyway. Then when they talk to their loan officer, whether it's with a bank, which is going to be a way different rate than if you talk to a mortgage broker or a mortgage banker, it's very difficult to be able to really have borrowers understand what you're hearing, what you're seeing. Look, these are the parameters for you to consider when you're looking for a loan. And rate is just one aspect of it.
Absolutely, Jeff. Rate. I always say if you're rate conscious. A lot of people who consider themselves to be rate conscious really aren't rate conscious. And I have to explain that to them. I said, what do you mean by that, Charles? What do you mean? We want the lowest rate, I said, you say that right now. But if I put a low interest rate in front of you, that is a loan that requires mortgage insurance, is a jumbo loan, and has all these different aspects and overlays, and then I put a loan in front of you with a higher interest rate, maybe even double, that does not have the same requirements, and I show you a payment that's equivalent to that low interest rate, are you truly rate interest conscious, or are you just check stroking conscious? Are you conscious about the money that you save every month? So you have to explain that to people and let them understand there's a difference. If you truly are interest rate conscious, then that's one thing. But if you're like me, money saved is money earned from me. So I don't care if the rate is 10%. If my rate is 10% and I'm writing the same check as a 3.99 or 4.99 interest rate, then I'm really concerned about being check stroking conscious. That's what I'm going to be concerned with, Jeff. That's the most important thing. And I have to reiterate that to people and tell them, make sure you're clear. Interest rate is not everything. Because if you want my loan products, I'm not going to be the lowest interest rate in the market. But I promise you, we'll give you the best service at Malibu Funding. We'll stick with you. We'll go through everything. We'll do our due diligence to do the best we can to get you the best possible program and product for you and your current situation.
Now, quickly, we have about a minute left. Your place of business out in Las Vegas, Nevada, there's been some issues with price reductions and overall market, I guess, reducing the price. Some people are worried that they paid too much last year and now underwater. What are your thoughts on that?
It's just the natural evolution of loans. Those who will be first will be last. Those who will be last will be first. If you had a increase in the the appreciation of properties, and it went through the roof, and it went above and beyond of what you were normally used to. At some point, when it corrects himself, you will get back down where you may feel like it was inflated, and you feel like you may lose money. It's just a natural thing. I always tell people, get in, see your margins, set that cap, and understand that there's no need to be greedy to make money or to make a sound investment. And then get out low where you're not overinflating your situation and putting yourself in upside-down debt. I do believe that the properties probably are, Jeff. A lot of them appreciated a lot, and people feel that they're under the pinch of, am I going to be stuck in an upside-down debt? It's
Right.
happened. It's going to continue to happen, and it will happen. I just feel like the market is correcting itself now, and the values are coming back down to the reasonable value where they should be. It doesn't mean you're losing money. It just doesn't mean you're making the money that you thought you were going to make before.
Excellent. Thank you very much. Hey, listen, we're up against it. I appreciate it. You want to shout out a way by which people can get in touch with you?
Absolutely. If you want to reach us out, reach that good old Las Vegas number, 702-328-5191. That's 702-328-5191. If you want to email me, please email me at charles@malibufunding.biz. That's charles@malibufunding.boy Isaac Zenith.
Thanks, Chuck. Thanks very much for coming on the show.
Jeff, thanks for having me again.
I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, listening to the show, bringing to you good guests that talk about rates, they talk about mortgage products, they talk about the availability of funds. All of these are issues that really didn't exist 6-8 months ago, and the reason for that is the rates were so low, nobody cared about all that stuff. They just wanted to get in, get the lowest payment, buy anything, which is why the real estate prices went crazy, and now we're in a different type of market. And again, I'm Jeff Barton. By the way, if you want to see this show, you can go to YouTube. We put this show on YouTube on a weekly basis. Jeff Barton, the Mortgage Voice. We've been doing it for, easy a half decade, if not more. Show's 8 or 9 years old now. And Jeff Barton, the Mortgage Voice, is the place to go to see it on YouTube. And we would appreciate that if you get there, you join up, you sign up, you say you like it. Reason is that the more you do that, the more people get exposed to what we're doing. For instance, you're searching for something online or on YouTube, and my particular show has X amount of people on board and X amount of people watching on a monthly. Yeah, you're going to get a little bit of information sent to you your way from me and the show via and thanks to YouTube. So it's good, it's important, get it done, and I appreciate it. Again, I'm Jeff Barton. This is The Mortgage Voice. Let's get right to it. The news to use section, the interest rates. We talked about it a little bit. 6.14 on a 30-year fix, 5.40 on the 15-year, 5.82 on FHA, 5.72 for the jumbo, and 6.05 for the 5/1 ARM. The 2-year is at 4.2%, and the 10-year is at 3.65. Now, that spread is still a half a point. And the interesting thing is, it historically had a large spread. Right now. And as we all know, as we've said on this show many, many times, this is supposed to portend or a recession is supposed to come if you have a spread like this for X amount of time. They've now gone to a different way of explaining it, i.e. what is the spread between the 10-year and the 30-year fixed rate mortgage. So if you look at that currently right now, we have a 10-year at 3.65. We have, let's say, it's 6.15%, so that's a 3%, 2.5%, 3% spread. Or 300 basis points. So what does that actually mean in terms of inflation? What does that mean in terms of recession? All of those things being interesting. Yes, it is. And we bring these information pieces to you just so that you have an opportunity yourself to go, oh, okay, that's kind of interesting. Let's go check that out ourselves. Go on to Google. We use many different sites. I quoted Housing Wire a little bit earlier in the show, and certainly you can go there. You can go to Mortgage Solutions Daily. That's another one that I go to. And certainly any of the, whether it's MSN or whether it's Reddit or Breitbart, not them. They don't do financial stuff. Anyway, any of these places all have financial stuff, and they all do articles that are really designed to get you to read the article, whether it's top 5 cities of this or why your house is about ready to lose money, or, things that catch your eye and so you watch it. The main thing to look for in all these is trends. So if you read articles 5 different days in a row, 5 weeks in a row, you know that that is a particular thing that is worrisome in the market or positive in the market, and maybe it's something to pay attention to. But certainly getting a professional to help you in any of these decisions, whether it's to buy, whether it's to sell, whether it's to refi, or whether it's just to get advice about what to do about above 3 things that I mentioned, that's incredibly important. Let's get back to more of news to use. Wells Fargo says mortgage jobs down 377,600 year over year. That's a big number. We talked a little bit about it earlier, about how the mortgage profession was losing jobs, whereas most of the rest of the economy is not. There are 10 million jobs available out there, none of them in the mortgage space. Wells Fargo today came out and said they're getting out of the mortgage industry even further, meaning that they're only going to do business mortgage-wise with current customers. So if you are somebody out there in the marketplace, 5 years ago, 3 years ago, 6 months ago, you could have gone to Wells to get your own mortgage. We can't do that anymore unless you have a Wells account. So if you want to go and work for Wells, I guess you got to open up a checking account, and then you're one of their customers, and they'll do business with you. But that's just a furthering of the evidence that the large banks are no longer in the mortgage space the way they were 10 years ago, 5 years ago. Too much liability. They want to have a little bit more of a safe environment, I guess. So that means your mortgages are going to be done by bigger and bigger mortgage banker companies, i.e. United Wholesale or Quicken Loans, which is, of course, Rocket, Loan Depot. These are the big boys on the block. There are certainly any number of other smaller lenders. Malibu Funding, the company that sponsors the show and I work for, they also are mortgage bankers. So getting used to a different marketplace in order to be able to get out there and get a loan is the way to do it. A lot of people don't feel safe going to smaller companies, but at the same time, a smaller brokerage can shop your loan to 40 different lenders, whereby if you go to United Wholesale or you go to Rocket or you go to Loan Depot, you're pretty much locked into them, their products, and everything else. So that's the difference between a broker and that's the difference between a mortgage banker. And again, they're both good. It just really depends on what you are and what the type of loan that you're trying to get really is. So back to it. Unemployment rate, we said that, down to 3.5%, adding 223,000 jobs for December. That's still a big number. And again, the 10 million people still looking, 10 million jobs out there available. You can go and do that. The mortgage rates, twice what they were 1 year ago. That's very interesting to understand. The reason the mortgage industry is doing so badly, obviously, everybody, 3% last year, we have 6% this year. In 1 year, it's gone up 3%. That's almost unprecedented. Now, I hate that word and hate the term, but when something that has never happened happens, well, what are you going to say? Yeah, it's kind of an unusual happening, and it certainly hurt a lot of people in the business, although I think if we can get inflation under control, now I say if, of course, because the Fed is still not weighed in on whether they're going ahead this year, 2023. It was predicted by Jamie Dimon, who is, of course, the head of Chase Manhattan Bank, that we were going to have 6 or 7 raises last year and end up about 5% in terms of the short-term interest rate the Fed dishes out. That all came true. So he's a guy to listen to, and he's been around a long time. He went through the 08 crisis, managed Wells through all that, as well as the last, 10, 15 years. So he's a guy to listen to. There are others. There are economists. There are analysts. And there are loan officers. All of those people are very invested in getting you to do a loan. So just make sure that you get some perspective on both your job, your situation, what's going to happen in the next 6, 12 months, the next 3 years, 5 years, 7, 10 years, so that you can make sure that you're not in one of these industries that is volatile like it is now. For instance, if we see oil prices fall through the floor, and I don't think that's going to happen, but then you're going to see a lot of people in those industries out of work, and that, of course, will affect mortgage payments in states like Texas and Louisiana and California, certainly, and anybody else who's got shale oil, North Dakota, South Dakota. So if we are in fact in any market that industry is looking not so great, and you're looking to buy, purchase, or get it back into it, yeah, these are some of the things that you've got to consider. Okay, a couple other things here. Good time to buy a home. 21% say yes, up from 16% in October. We're a month behind on these sentiment charts, but that's a pretty good thing. It bodes well for this year. Now, 21%, you may look at that and go, oh, that's terrible. Well, it's better than 16%, so trending in the right direction. The housing inventory is up 61% from 2022, but down 42% from 2019. So you can see pre-pandemic levels of housing inventory were really rising in 19. What we were going to see is absolute ability of homeowner to get in on a pretty reasonable rate in terms of their mortgage, but also the availability of housing, which also affected price. 61%, wow. So the amount of properties available currently right now, 491,000 nationally. Okay. Redfin says 22% of home sellers sold below list in 2022, 22%. Now, we went through it during the summer and late fall about each city that were high on the list of those properties that were selling below what they asked for. A year ago, that wouldn't have happened at all. You would have had 15 offers and sold, above asking, absolutely. But 22% sold below, that means that you're probably going to see in those markets the actual listing price come out be 22% less this year. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for tuning in, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show, giving you information about what we're going to be doing this year in 2023. As I said earlier, this is a turning point in a lot of different ways for the financial markets, whether the Fed is going to cure inflation, whether we're going to see a recession, whether the availability of property is going to be so low that prices continue to go up. All of these things are consideration when you buy. Well, another thing about buying is if you're looking for something new, if you're looking for a project, if you're a builder, if you're looking for financing for certain types of other investments in real estate, all of these things are very, very important. An expert in that field of all these things is Josh Thompson, who joins us again from Equilibrium Financial. Josh, how are you?
I'm doing great, Jeff. How are you?
I'm fine. Thank you very much. And I know you're driving to your next appointment. I'm glad it's not raining right now, so it's somewhat safe. What are your prospects for 23?
Oh, yeah. Should be done with this Inglewood project where I'm doing 20 homes. We've been talking about that for a while.
Yep.
So construction is moving smoothly on that now. Got over some mishaps, and then I have another project in Joshua Tree, California, high-end home I'm doing there that is in the framing stage right now, so that should be done in May or June of this year. So, also looking for some new deals.
Well, that's interesting. In a market like this where you have and have had a rise in interest rates for residential property, how much does that affect financing for projects that you're looking to develop?
It does have an impact on them. It's really, it depends on what kind of project you're doing. If I'm doing like a, fix and flip kind of deal and doing getting a hard money fix and flip loan on that, those rates are still pretty comparable to where they were before because they've always been higher interest rates, ranging from 8.5% to 11%.
Right.
You just want to make sure that, but if you're looking at like kind of like a bigger ground up construction deal, it's having a significant impact on those because there's not as many banks that are even willing to do those deals at this point. A lot of banks have rolled up their construction lending altogether, temporarily. And they're also, not giving you as much leverage as they were before. And that higher interest rate on those bigger kind of projects can really make or break, your margin on something. So I don't think I'll be looking at anything in the large realm in the near term, but I do think there's some new zoning regulations I think that have kind of come into play in California in terms of increased density and transit-rich areas. So I think those deals are kind of safe, and there's also new ADU regulations that are allowing you to put multiple ADUs, an ADU and a junior ADU on properties that are also multi-family properties. So I think those are the kind of plays that I'll be looking at this year. Projects where you can maybe buy a residence with a large lot and increase the density of the property into multiple units. So.
That's interesting that they link it up with transportation, right? Obviously, if you have a lot of people, more people on one particular lot, they all can't park there, so they're going to have to rely on public transportation. As long as you're within a certain zone of either the bus or the subway or some other way that you can get to work, I guess that makes it a little bit easier to get the permitting.
Yes, exactly, and that's always been a huge problem
right.
With larger projects. Is where are the people going to park? So
right.
There used to be requirements for 3-bedroom units would require at least 2 possible parking spaces, and that can kill a lot of projects
sure.
if you're not able to get the parking. But now especially in LA County, there's been a lot of things to kind of supplement that, and there's a little more understanding with local municipalities in terms of using bike racks to replace kind of some of the parking requirements, and now these kind of things where they are allowing transit-rich areas to increase density. There's also lax parking guidelines on that now as well. So.
Now, when you're looking at projects, I mean, there has been such a change in leadership in the city of Los Angeles, and now I know you do some projects elsewhere, but let's just talk LA. Karen Bass, I guess, is the new mayor there. They've gone after these homeless encampments. Does that affect financing? I mean, is that one thing that is looked at, like the propensity or the collection of non-residents in an area, either camped out or, I mean, do the inspections show that kind of thing? I was always wondering whether that affect not only the financing, it certainly affects quality of life, but I just didn't know.
Oh yeah. I think those things are looked at on the on CEQA reports.
Yep.
Depending on the kind of project that you do, those analytics are definitely in those reports, and a lot of projects in California require these CEQA reports. But
sure they do.
Financing, not so much. I
okay.
have not seen that come up as an issue in construction financing. But I also would like to say I don't particularly agree with the approach that Karen Bass is using with that. I know that there's also a lot of I've had some clients that have wanted me to kind of consult on development projects in the last month or so. I guess there's some sort of funding that's being provided to people that want to do residential development for homeless housing, and
right.
I've had actually a few clients reach out to me that are not even developers that are trying to take advantage of these kind of funds that are out there, but I don't know per se if that's actually going to solve the problem with the homeless issue that's here, but
Well, I think there are a lot of different views. I think at City Hall, with the change in leadership there, it's a wait to be determined. There are these funds. I mean, I don't know, 5 years ago, there was that $2 billion bond that we all voted for because it was going to solve the homeless crisis. 50,000 new units would be built and blah, blah, blah. Well, guess what? Now there's 100,000 people who come to LA looking for that kind of help. So figuring out how to solve that kind of problem, especially if you're a developer, you're somebody that wants to build or rent or just build to own, it's a consideration because obviously the value of what you're trying to do needs to have a certain valuation and an end product in order to get financing. And does this kind of problem hurt in financing? You're saying no, but it is a consideration in some of the CEQA stuff.
Oh, absolutely. But I'm starting to see, I mean, the issue with, I'm starting to see in different neighborhoods in Los Angeles where I've never seen, the homeless encampments and
yep.
things like that. I mean, in my, I've been a Los Angeles resident since I was born in 1989, and in Westchester, California, I just saw this at
yep.
a park that I've frequented, over the years, and there were a ton of tents at Westchester Park, and that's something that I've never seen. So even at my project in Inglewood, there was a guy. While we had it fenced off and everything was demoed, we had it sitting that way for about a year. And this guy went on the property and he built his own version of a home on the property and told the police that he lived there. And I mean, we tried so many different times to have him removed from the property, and the police just said they couldn't do anything. So it's an issue that I don't really understand, and it does have an impact.
Yeah.
I think a lot of Californians are starting to just we're so used to it now at this point that I see people buying $1 million homes on a block in Hollywood with tents right down the street. So I don't know if that's a good thing that we are that used to it, that we're getting immune to it, but it's definitely an interesting problem that I do not know what the solution is for.
Okay, yeah, I don't either. Now, you're obviously very, very schooled and knowledgeable about development. How would you tell somebody, or how would you advise somebody, like you said, you were talking to people who don't develop but wanted to get in on some of the city funds that are out there available for housing. How would you advise somebody getting into this marketplace? We have about a minute left.
Yeah, I would advise someone that's looking to get some of those kind of funds for homeless housing and different affordable housing funds. I would advise them to kind of partner up with a nonprofit entity because that makes you a little bit more attractive in terms of receiving those funds. And then you definitely want to go big with whatever you're doing, because those funds, funding sources, is very competitive to get those funds, and they want to make sure that these funds are being applied to projects that are going to serve the most people. So you definitely want to go big, and you definitely want to have a nonprofit entity that's somewhat familiar with this and has a track record to partner up with, because that will better your chances of being able to secure that kind of funding.
That's good information. Josh, shout out your phone number in case people are listening, want to get a hold of you about this particular topic.
Oh, yeah. My number is 323-945-5694.
Thanks, Josh. Thanks very much for coming on the show. Really appreciate it.
No problem. Thank you, Jeff.
Thank you. That's Josh Thompson from Equilibrium Financial. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Welcome back to the show, and thank you very much for listening, for tuning in. You can see and hear this show weekly on KCAA. KCAA is, of course, in the Inland Empire, and they have a plug into any number of different podcasts as well. And so if you want to see and hear us, certainly their particular website and their particular archives can get that. YouTube is another place. You can also go to my website, themortgagevoice.com, and you can see and hear not only the show, but you can see some of the guests that are on there, contact them directly. They're all good places where you can get in touch with me. I am Jeff Barton. I work for a company called Malibu Funding, 79620. That's their NMLS number, and they sponsor the show. So, again, thanks very much. I am Jeff Barton, and this is The Mortgage Voice. Okay, so let's get back to news to use. Some of the things that we talked about earlier in the show, inflation as such. There's a Fed survey that came out. The Fed does a lot of different things, and they're in the news constantly, obviously trying to stem the tide of high-rising inflation, which they have done to some extent. And we have seen the rise in interest rates. I think there were 4 75 basis point hikes in a row last summer, ending in, I think, October. The December Fed meeting saw a 50 basis point raise, and I think we're going to see another 50 basis point raise at the end of January. But what do they say in the survey? So they ask their particular surveillance, whoever they're asking, about things like inflation. So the Fed survey says inflation to come down in 2023. Okay, well, we all think that. We're seeing the trend in that. The question is, how long and how fast is it going to happen? Spending to come down too in 23. Now, I'm a spending kind of guy who likes not to spend. I'm just, one of those type of people that thinks it's better to have money in the mattress or the bank or whatever it is, some liquid asset that you can get to it right away in order to be able to, rainy day fund and all that. In the state of California, some of you may have heard this too, we're projected to have a budget deficit this year of some, $40, $50 billion. Last year we were 75 or $95 billion surplus. And these great swings in what happens with money coming in, money going out. And if I ran my own home like that, of course, everybody here knows what that means. Of course, you can't run your own home like that. You either got enough money to live on a daily and a weekly, even if it's month to month, you have more money than is coming in than going out. That's extremely important. So for me, a spending cap, a limit, is a good thing. And I think both locally we should be doing that, statewide we should be doing that, and certainly nationally we should be doing that. I think a $31 trillion deficit nationally is, it's a number that when I was a kid, I remember the term zillion. I don't know, when do we get to zillion? Do you know, Daryl?
I don't know when it actually started, but certainly it was something was a number that you just made up for something that was unbelievable.
That's right.
$1 zillion.
Exactly. I think actually we're going to get to a zillion. I don't even know what that means. Is that a trillion trillions?
I believe that would be 100 million.
100?
No, it would be 1,000 million.
1,000 million?
No, it's a billion, so it would be
a billion, a trillion, but each goes up 10 times, right?
Yeah. But
is anybody out there who has any answers on this?
How many zeros on a zillion?
Oh my gosh, yes, too many. So if you're out there and you're listening to this silliness, you realize, of course, that yes, it's true. We spend way too much money, and that hurts you, the consumer. It hurts me, the business owner and consumer, way more than if we dropped some of the services. Now, we talked earlier segment to Josh Thompson. We talked about some of the things going on in the Los Angeles area about housing and homeless, and we got sort of sidetracked a little bit. But one of the things that Josh did mention was housing itself and the government's involvement in trying to solve the problem by throwing money at it. And again, I always think back to the day where we were convinced that this $2 billion bond that we were still paying for was the answer to the homeless problem. Well, it's never the answer if you're giving something away. Why? Because then somebody else wants it and they show up, and of course you got to give it to them. So what is the answer? Do you be heartless and throw people on the street and make them go sleep, not in my neighborhood kind of thing, or do you provide for them? I think that there is a way to be able to do this in a much different way than it's currently being done. And again, it's to spend less, make people responsible more, and to be able to reward those who actually, we have 11 million jobs that need filling in the U.S. So some of the people that obviously can work should work, and those people should be part of the solution in terms of getting off the street. I just think it's a good thing.
A zillion is actually not a real number.
It's
simply a term that's used for a determined but extremely large quantity.
Excellent. No,
yeah.
and
I went to about a zillion sources to figure that out.
No, that's very good that you came up with that, because that's exactly what I need to hear. That zillion is not a real number. Yeah, and quite frankly, I didn't think trillion was a real number until it became a real number. So anyway, it's very interesting. Okay, let's get into a couple other things. Expectations, which the Fed says are key. The Fed's Michelle Bowman has a quote from her. Once we achieve whatever it is that they need to achieve in terms of the rate and inflation, the need to remain for some time. Now, what she's talking about, of course, is Fed continuing to raise short-term interest rates on their member banks. So if we've gotten to 4.50 and next month we're at 5%, does that mean we're going to get to 6% before we see inflation tamed enough? That's the first part. The second part is maintaining 6% borrowing rate for members, banks mainly, for the long term. So meaning that's not only are we going to get to a place where inflation is under control, but we're going to sit on that number until we are sure we've beaten it down so much that it's not coming back. Now, because the economy is strong, we're going to see a GDP in the fourth quarter almost close to 3.5%. Way beyond what they thought, not as good as it could have been, but the fourth quarter was actually pretty good. As everybody knows, the second and third quarter last year were negative, so we were in the short recession. If technically that is a recession, which there was some argument about. But regardless about the semantics about it, how do you feel about what's going on? How do you feel about the country and the direction economically where it's going? You live in San Bernardino and Riverside. What is the employment out there? How is it affecting your daily decisions? Are you secure in the job that you have? What is, the outcome for you, the prospects of you either refinancing, purchasing this year? These are questions for obviously people in the marketplace, and you are one of them. Okay, another point. How rate affects affordability. So every time the rate rose last year, fewer and fewer people were able to borrow because they just didn't make enough to have the ability to repay rule, that calculation be met. I got just a couple of figures here just to give you an example of what actually that means. How rate affects affordability. In January of 2022, the rate for a 30-year fixed rate loan was around 3.25%. Price for an average home, $450,700. Income in order to afford that was about $104,000. And the people that could afford that in that scenario, and many, many millions of people could have fit in that scenario, was about 34% of the people in the U.S. could afford that. Okay? Now, switch to a year later, and this isn't even at the top of the mortgage rate interest. 123, let's just say a couple days ago, or it'll be 123. Anyway, the rate is at 6.5%. The price on the home, the same, $450,700. The income has risen in order to meet the ability to repay rule, $139,221. And the percentage of people that can afford at this price is 22%. So over a year, we've lost 12% per se people who used to be able to afford a home who can't afford a home. That's a big number because most of those people are first-time home buyers. They're not people, stepping down. They're not people, buying a second home. These are people, first-time home buyers, who can't get in on the American dream to own a home, because that's the way you build wealth in the U.S. of A. I'm Jeff Barton. This is The Mortgage Voice. I really appreciate you listening to the show once again, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
A journey of 1,000 words begins here. KCAA.